Hey there. Just want to record a quick video, talk a little bit about refinances. Refinances are back, believe it or not, after quite a wait. And I'm super excited. Rates are the lowest have been in a little bit over a year now. And so refis are back. Now, as of right now, when I record this, December 2023, there are some people that should refi and some people that should not refi. And so in this video, I'm going to outline the situations where it might make sense to reach out to a loan officer and refinance. So my first point is refis, if you take one, should be a hell yes right now. Now, what is a hell yes deal? A hell yes deal, in my opinion, is one where it's obvious that it needs to be refinanced. That there's so much savings there that you don't have to think about it. You need to do it in a spreadsheet. You don't need to talk to the spouse. You go, hell yes. If it's the kind of deal that I can pitch on someone in 2.5 minutes and get them to say hell yes, that's the kind of deals that should be done. Now, we're going to be seeing some lower rates in the next year, I think in 2024. So if it's not quite a hell yes deal and it's just kind of an okay deal, it might make sense to wait a little bit. So that's why I say only do hell yes deals. Now, what defines that? I would say it's partly because of what's called recoupment time. And whenever you're refinancing your house, you have to figure out the recoupment time. So recoupment time is your cost divided by the savings. So as a quick hypothetical example, if someone had to pay $1,000 to refinance their house and they're saving $100 a month, that would be a 10-month recoupment time. Now, right now in this market, I certainly wouldn't recommend if you had a recoupment time over a year. I would definitely say not to do that. If you can keep that 6 months or less, definitely do that. If you have the option to take a lower rate with higher closing costs versus a slightly higher rate with lower closing costs, I'd say take the lower closing cost deal every single time. You're the lowest cost, not necessarily lowest rate right now, because there's going to be more refi opportunities down the road. We just don't know when those are going to be. So take the quick hit, take the quick fast, take the hell yes deals with quick recoupment time. So let's talk a little about what are some situations where a refinance would make sense. So, for example, if you have a VA or FHA loan, there's a pretty good chance that a refi might make sense right now. Now, especially if you bought between November of last year and May of last year. If you purchased before November, most likely rate's going to be too low to matter. And if you purchased after May, you're most likely not in that period yet, because you do have to make those 6 payments on VA or FHA to get what's called a streamline refi. Now, streamline refi is really interesting because we don't check income. It's a very little credit check. It's streamlined, a lot less cost on it. So on the FHA side, it's called an FHA streamline. On the VA side, it's called a VA IRL, but they're basically the same thing, where it's reduced credit requirements and very little income requirements to check everything out for the loan. And so because of that, the costs are much lower. The other one, especially on VA, is if you're collecting VA disability, it's a great time to do those IRL streamlines because the costs are so low because you don't have that funding fee to pay again. And oftentimes, depending on the lender, oftentimes we can waive title fees. Like I'm doing one right now where I'm waiving the guy's title fees. It's coming out of my check, so not necessarily waived. It's still cost, but I'm covering it out of my commission, and there's enough money in the deal where I can make that happen, and I'm glad to make it happen. And I'm covering his filing fees as well. So his net cost that he has to pay is like $600 or something. It's really, really low, which makes that recoupment time super low, which makes the deal a hell yes deal. So back to that. The other one where it makes a lot of sense if you have those higher balances, if you owe over $400,000, the refis oftentimes are super easy to justify because that little half point to 3/4 of a point in rate on those higher balances, it doesn't take much to save that $2,000 or $3,000 that it would cost a refi. So definitely those higher balance deals, you should be calling a loan officer every time you have any sort of rate dip, because most likely you're going to be able to save money on those refis. The other one to consider is if your credit score has increased since you bought the house, because oftentimes, the rate that you pay is based on your credit score. So if you have a low credit score and didn't pay a lot of points, then most likely you have a much higher rate, and there's a much higher spread than if your credit score didn't move at all. So, say you had a 610 or 620 when you bought the house, and now you have a 740 for what, maybe this credit repair, everything looks good now. There's going to be a much more of a larger difference in rate than if you're going from a 740 to a 740 on the refi. So definitely, if you have those big credit score jumps, you should definitely look at that. Other one that people don't think about is if you're changing mortgage types. So this is like if you're going from FHA to VA, going from FHA to conventional, or maybe you did a alternative lending non-QM product. Maybe you're self-employed, didn't have those taxes set up, and now you do. And you're going from FHA to conventional, or I'm sorry, for non-QM to conventional is what I'm trying to say. For those type of situations, you can save huge money by changing mortgage types. So, if there was a change in your income and credit situation and you can change mortgage types, now is a perfect time to do that. Another really good situation where it might make sense to refinance right now is if you need cash out. Credit cards are at 22%, I believe. Well over 20 or 22, something like that. It's pretty high, and they keep going up and up because it is tied to that Fed funds rate. So if you need some cash out, you can take some money from the house, roll that in with the credit cards, and look at that blended rate. And so most likely the blended rate you're currently paying between your mortgage and your credit cards is probably 9 or 10%. And so moving that down into the sixes, or maybe mid sixes probably on that, it's not an offer to lend, so I wouldn't know. So probably in that range, mid sixes, low sevens, like somewhere around there on that cash out, which would be definitely better than paying 9% blended on, a credit card plus a mortgage. So those are your options if you are trying to refinance. Now, if you have any questions, as always, give me a call at 937-572-3713. I can also be reached at scarpero.com. Talk to you later. Bye.